Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trade. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commissions costs are excluded. Neither World.com, ESW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. ESW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media are identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right. That was fantastic, wasn't it? All right, how's it going, guys? Let's see how everything's going. I think we have a nice little sell-off in progress. Well, on the daily chart, certainly we do. I mean, a little pullback, no biggie. But, you know, I mean, as we expected, a little pullback, no biggie. And, I mean, frankly, look at the weekly chart. This isn't even a pullback here, guys. when you go from 4,700 to 6,200, that's 1,500, right? So that's 30-something% run. So like a 33% run or whatever. So here's a 33% run, and we're pulling back this much. That's not a pullback. A 6% pullback would be the minimum you'd expect on a 5% rule, and 6% would be all the way back to like 6,000. That would be the minimum pullback you would expect on a run like that. We're not even close, and that would go for all these indexes. It's going to look the same. Well, they all went up the same. They all have a pullback. So you look at S&P 2,500, Dow 2,300, Russell maybe 1,450 if you're going to be generous. You know, everybody's going to pull back. The Nikkei pull back. The Nikkei looks 17 to 23. Okay, 17 is 6. It's more than a third. Everybody's up like 35%. 3,000 to 30. What is this? 36. That's 20, and that's the so Europe's a little bit light. They're at the 20s. How's the DAX? 10.5 to 13.5. Well, that's 30%, obviously. So you know, so the euro stocks. Germany's doing well. So everybody, it's a global rally. It's a huge, massive global rally. That's, you know, obviously ridiculous because if things grew 30% a year, it would be completely out of control in no time, wouldn't it? And that's what I wrote the other day. I had that article that said everyone will be billionaires, because if you keep going at this pace, stop buying. Where did I write it? See, I didn't make a sudden decision to get out. This started last week when I wrote, we will all be billionaires. And at the time, the long-term portfolio was up 249%. Oh, and here you go. This is probably a good example. I don't even know what it is, but let's take a look. The long-term portfolio, since last week, I'll feel silly if I'm wrong, but it's up 260. There you go. So now 1.8 million, and last week on Wednesday it was so it's up $50,000 in a week. That's not bad. This is stupid. And you can't sustain that. You can't keep giving. I don't care how smart we are. You can't keep giving people $50,000 a week, which is, how many weeks are in a year these days? I don't know. Trump changes things a lot, so whatever the rule is now. But let's say there's 52 weeks in a year still, and we multiply that by $50,000. It's $2.6 million. So at this pace, our $1.75 million portfolio will gain $2.6 million in a year. So meanwhile, you have the Fed telling you there's no inflation. It feels like inflation. I know I've got a lot more money. It's not a sustainable thing. Something is going to happen. There's two things that can happen. Either this whole house of cards collapses, or if it doesn't, then people like us playing the market will have so much money that it'll inevitably cause inflation. You can't have that much. You can't double the amount of money people have. Even just us in the top 1%. We talked about that this morning. We in the top 1%, or those of you in the top 10%, which is very sad if you're only in the top 10%. But here's all the wealth in the world, or in the country, but the world's not much different. Here's top 1%, this dark green line. And we have just about 40% of all the wealth. This line, this other line is the next 9%. They've got 40% of all the wealth. Okay? So we have 40 and they have 40. That's 80% of all the wealth. Who's got 20% of all the wealth? The other 90% of the people. So when I say us, I certainly don't mean them. Okay? And the fact that you're here and you have time on a Wednesday afternoon to sit there and listen to a webinar means you are almost certainly up here. You're not a working person with a 9-to-5 job, most likely. And if you are, God bless you, because you should be doing stuff like this, because you're not going to make any money doing this. Obviously, you're not going to make any money doing this. Anybody who told you this was a good idea in 2004 screwed you, because you were making 30% of the money. Now you're making 20% of the money. Trump's new tax plan, you're going to be down here, 10%. We are literally, I would say at least 5% lower. We are literally going to take about 1/4 of the money away from the people who in the bottom 90%. We're going to keep taking their money until they revolt. That's the plan. You have to. There's no one else to take the money from. We will take the money from the next 10%, sure. I mean, because they got some money. But we'll drop these guys. These guys will drop 5%. But you know what? They go down 5%. We go up 5%. That's the same amount of money. So we only have to take 5% of the money from these guys while we make more money. So that's fine. But to get money from these guys, it's going to really hurt them, because just for us, because we have twice as much as they do. So for us to take $1, we have to take $2 from them. For us to get $1 more, we need to take $2 from them. They have half as much money as we do. That's the way it works. Okay? They've got, so let's say $50. We have $100. If we want to make 10%, we need $10. $10 from them is 20% of their money, not 10%. It's 10% more for us, 20% less for them. The same $10 just doesn't mean as much to us, but we'll take it anyway. Because that's the game. That's capitalism. The problem with capitalism, there's no winning. There's no end of the game. Baseball has a thing that says after 9 innings you stop playing no matter how badly you're beating someone. Capitalism doesn't have a rule like that. Football says after 60 minutes of playing time, the game is officially over. Okay? If it's not over, you're going to sudden death. At least you have sudden death. We don't have sudden death. We keep beating and beating and beating on these people until they are dead. They are either going to be dead or they will be a revolution. There's only two real outcomes here. If you fail to lift them to a level where they are happy, they will either die or kill you. Those are the two possibilities. It's very simple. It's happened over and over again in history, yet for some reason everybody pretends that's not what happened. It just happened in Russia 100 years ago, right? They killed the royal family. They murdered them all, even the children, to make sure none of them ever came back. That's how much they hated them. I mean, it's just, and that's what we're building now. We're building a new royalty where we're a very, very small amount of people have everything and the people have nothing. and you can stomp on the people all day and all night, and you can spend more and more money for security, but eventually the people will kill you. All right, but we're far away from that. I'm not worried about that yet. For now, we're just going to make more money. for now, it'll just get worse and worse for those people. But it is alarming how fast this curve is moving. Okay, here we were at 37% in 2004. A decade later, we've gained 10%. We've gone from 37 to 40. That's 10% for us. And the curve is getting stronger. And think about what's going to happen. I talked about this morning that, Uber is a good, oh, that's not this morning. Is it? Wait. It is this morning. I read about Uber. Uber. Tax cuts. Oh, down here. Sure. Here it is. Okay. All right. I use Uber and Lyft as a good example of automation. It keeps it simple. Like, what's this whole robot thing about? And here you have Uber and Lyft, which are using 500,000 drivers who work for them to gain market share. But their business plan, the reason Uber is valued at $60 billion is not because they're not even making, because they spend money to do all this. But, their revenues are about $3.5 billion a year in revenues. And they get that from their 20% of the drivers' money. This is 500,000 Uber and Lyft. But let's say Uber gets $3.5 billion from their drivers from all these trips. That's 20% of the cut. The drivers then obviously get 4 times 3.5, which is 12 and 2 more, about $14 billion. All right. Oh yeah, we've got it perfectly. Okay. It's exactly what the number is. Do it in my head and it works out. So the drivers are getting $14 billion. Uber's getting $3.5 billion. That's their cut of the total revenues. And but why is Uber then valued at $60 billion when they're actually losing $1 billion a year or a quarter? Actually, I think they're losing $1 billion a quarter. Because of their promotion, advertising, they push to expand, so on and so forth. All they care about is acquiring more and more customers. And to do that, they have to recruit drivers, and they're paying the drivers anything. They don't care if they make or lose money right now, because that's not their plan. Their plan is not to make money having drivers drive people. Their plan is to have cars that they own come and pick you up with no driver in it and take you where you want to go. That's the future of transportation. But how does the future of transportation affect the workers? Well, they're gone. So for now, Uber is telling these 500,000 drivers, or Uber and Lyft, are telling their 500,000 drivers, hey, work for us, and we will reward you here and here and whatever, and do anything, and make, it's all about making the customer happy and whatever. Because what Uber and Lyft care about is having that loyal customer base. And you're not loyal to a driver, and Uber makes sure you're not loyal to a driver, because there's nothing in Uber that ever says request this driver again. Even though logically, if you like a driver and you have a good experience, like if I go to the airport and a guy picks me up in a car, okay, and I like him and he's on time and he's friendly and he's nice and whatever, all right, and I like it and it's all a good trip for me, then I would want to use him again. And meanwhile, I know he's in my area. So why can't I favorite him as a driver? Because Uber doesn't want me to favorite him as a driver. And frankly, if I ask him and if he offers to do something off of the books, he loses his Uber. It was very strict about everything, and they want to be. They don't want you to have a loyalty to the driver. They want you to like Uber, not to like the drivers, because the drivers are all going away. As fast as they can possibly do it, they are going to automate the cars and have you picked up by driverless cars that will pick you up, take you where you want to go, drop you off, and you're charged, and that's that. All right? And meanwhile, it's going to be a fantastic service to the consumers. It's great for us, but these 500,000 guys lose their jobs. And Uber makes a ton of money. They're going to make the $3.5 billion they make now, less expenses and whatever, but they'll take on an expense for the cars, probably another few $1 billion, because they don't have to lease and maintain the cars instead of the drivers doing it. And then they'll have to have some sort of an infrastructure for that too. But the big deal, though, is they're getting the $14 billion that the drivers were getting. And suddenly, instead of being a company that barely makes $1 billion a year, there'll be a company that's making $10 billion a year, $8 billion a year. And of course there were $60 billion in that case. And that's what the game is. And a lot of companies have this plan. They don't like to talk about it. Uber doesn't even talk about it. They don't really, they talk about the driverless future, but they don't talk about, they always like to pretend that it has nothing to do with the drivers. And I'm like, well, if your future is driverless cars, then your future isn't the drivers. And I ask the drivers about this all the time. They're all in denial. They're all like, oh, no, they only have some driverless cars. I'm like, why? If it works, it works. It's like in your house, you only have some automatic dishwashers, and otherwise, a lot of people do it by hand just because, that's good too. So it doesn't work that way. You invented a dishwasher, washes dishes, everybody has dishwashers. You don't like say, it's nice, it can be done really fast, but I'd rather, sit there and scrub them. I know some people do, but, that's weird. Washing machines too. Like you want to sit there with a little washer board and get your clothes clean all the time manually, sure, you could do it. It's just not really what's going to happen, though. What happens is as quickly as people invent these kind of things, they spread like wildfire, take over, and that's that. And everybody forgets that we even used to do it another way. There are some shocking pictures here. Let's see. Manhattan horses, cars. What are you going to get? I'm looking for like a picture that shows you because I've seen plenty of them. Anyway, I'm sure you've all seen it. There's these pictures in New York where you see, the street and, well, these are different cars. But, this street, like, let's say 10 years earlier. This is 4:15, I don't know. Oh, 21. This is 1921. Okay. So here's 1921. All cars, no horses, right? This looks like Central Park. And a trolley of all things. Anyway, so like, they have pictures like this where like this would be like 1910, and then in 1905, it's all horses with one car. And that's how fast it changed. In like 5 years, all of a sudden, this disappeared completely. Here's a trolley in 19 whatever it is. They call them a horse car. And then all of a sudden you've got these things instead. And the cars and all the horses are gone. That's how trolleys started, these things. Same thing, just get rid of the horse. Nobody cried over that. Hey, that's what the trolley tracks are for. Oh, there's one. See? The horses don't even know they're all going to be glue. And see, I mean horse. So this is right around the transitional time, 1917, in fact. And you see there's like still people with horses and some people have cars. There's a trolley and a horse trolley. So it's like a real transitional period here, but literally in less than 10 years, it went entirely cars and trolleys. And then the cars ran the trolleys off the road too. So that's how fast this is going to happen. Everybody's like, you think it's the far, far future, but these electric cars are going to start rolling out definitely by 2020. Maybe sooner, but definitely by 2020. Driverless cars are going to be on the road, and 10 years later, By 2030, there will barely be a car that has a driver. So that's it. My kids are the last generation that's really going to drive cars. They're just getting their licenses now. And they are about the last generation that's actually going to even bother driving a car. It's just not going to be a thing. Just like you don't know how to ride a horse. Okay? I'm sure in 1920, it was still considered very important to learn to ride a horse. Even in 1930, I bet you most people thought they should learn how to ride a horse. By 1940, I'll bet nobody rode a horse. What's the point? Why would you ride a horse? There are no horses. It doesn't take long before people don't bother. That'd be an interesting thing to know, is like the statistics of how fast people stopped even bothering, learning to ride a horse. You couldn't live a life in 1910 without knowing how to ride a horse. But by 1930, there were no horses. Think of like King Kong, right? That was made in the 30s. There's no horses. He didn't like run down the streets of Manhattan with horses. Nobody's riding a horse. Does not take long for society to change very drastically. All right. Joe wants to know, did you ever dump your 2 natural gas, blah, blah, blah? Of course, right after I ask, it's back to 28.75, go figure. No, because I don't look at it like that. You guys are all crazy. I don't even know what it is because I don't care. It's whatever it is. I don't buy positions where I'm like in and out like crazy. I can't take it. Plus, it's an 8, right? It's an NTB 8, isn't it? Oh, oil. Oh, look at that. Oil's going down. Hang on, let's buy something. NGV8. Yeah, I have 2, and they're 287, which is right where it is now. But I mean, I didn't buy the October natural gas contract to get in and out of them constantly. If it had a good run, if it zoomed up here to like, it's almost here's $3. If it ran up to $3 and it stopped, I would say, you know what, I'll take a profit here because I think it might pull back again because it keeps stopping at the $3 line and pulling back. But I'm not going to constantly go in and out of it. Oh, here's gasoline though. Look at gasoline. This was a great buy here. I wish I was paying attention. So 167, let's take a shot at that. Stop. Buy one. See if I can get 167. If I get the fill, I'm going to be nervous. It's not that strong. So I put an offer at 167. We'll see if it fills. Oh, there it goes. Okay. All right, so we got one long here. Because usually to the weekend there's a little bit of a pop-up. And right now we had a big hit on oil because there was a bad report. And it showed weak demand and so on and so forth. But still, it's not going to be, it's not that drastic. Some weeks we have a draw, some weeks we have a build. 1 week doesn't prove anything. So after a nice drop like this, and it's down quite a bit, it's kind of fun to play for long. Now in gasoline, every penny is $420. So if it hits 170, I'm going to be up $1,000. I'm not looking for a huge win here. I'm very happy to take $500 off the table. It's just a little fun play. But long on natural gas at 167, that's a good play. I'm not natural, it's like gasoline. And let's take a look at what the gasoline looks like. Here it is. Now, this is a weekly chart. Notice that we're not really cheap. Okay? It's not even low in the range here. All right, so we shouldn't get too excited, but it's a weekend, and I think we'll get a little bounce. Look where it's from. It's from 180 down to 166. And what do we know? We came off the 140 line with the low. 140 to 180 is 40. And that means your pullbacks are going to be what? Ignore the spike over. See how 180 gets tested here, and it's tested here. So 140 is a good line. To 180 and 180 again, and a pullback from 180. Now, since it's a 40-point move, your pullback is 8, 20% of the run. So pullback number 1 would be 8 to 172. And here's 172 holding here. That's a weak retracement. Okay, so that's where that comes into play. 172 came back and tested it again, failed. Now it fails 172. and now 8 more cents below that is 166. All right, so that's probably a good. Now, that doesn't mean 166. There's no law that says it's only going to weekly retrace, but it's saying that even if it does, though, this is a strong retracement, which means now that should get a bounce. And how much of a bounce do I expect off of 166? Well, it fell from 180 to 166 is 14. All right, so call it 15 cents, basically, and then say 20% of that is 3 cents. So even a weak bounce off 166 should take me back to 169. Now 170, 169. So I didn't get it, and it's not Matt's fault that I didn't get in at 166, right? It's just I didn't happen to get in at 166. So even though I'm in at 167, I'm only going to look for 169. All right, but meanwhile, if it hits 166, which it did already pretty much here, if it hits 166 again, I'll probably add one more red and stop out. And as long as we're over the 166 line, I'm still going to expect some kind of bounce up to 169. Because nothing has changed. OPEC is still doing their thing, and Christmas is still around the corner. Now, Christmas, as I said before, though, Christmas is not a big gasoline holiday. It's not a heavy bet. But it's a weekend. There's a good chance that oil will pop back up. And I think there's a better than 50-50 chance that this will make money rather than lose money. And so since I expect to make 2 cents on this trade, I'm happy to buy one contract and see what happens, even as it looks weak. And if we get back to 166, like I said, I'll add another one. That'll give me 2 at 165, 1665. That's a fun one to play. Natural gas, on the other hand, I have a long-term conviction on that, and I'm playing the October contracts. I'm not inclined to take a profit unless it's a good one. And I've also got silver out. Silver, and I got 2 contracts short there at, what am I at? 1604. I didn't double down. I missed my chance to double down because I was doing the webinar. I should have, right there, see? I could have gotten my double down exactly where I wanted it. See, I'm 4 cents above 16. When I was 4 cents below, I wanted to double down, but unfortunately, that was 115, and I was talking to you guys. So I didn't get a chance to double down. But anyway, so that was the plan. And why do I want to double down there? Because I started at 1604, and therefore I wanted to even it up to 16. And then when it gets to 16, I would reduce back to 2. Then I'd have 2 long at 16. That's how I work into these things. See, and this one's not going to give me my 166. It's going to go up now, which, it's annoying. I would rather it goes against me so I can get more, frankly. It makes me happier. Because it's hard when I make just a little bit of money on these positions. It's not that exciting. Oh, wait, I want to go back to the chart. Hang on. So it's a tough discipline. You have to discipline yourself to take the small profits and enjoy it. And they do add up, and they add up really, really fast. But I have the same problem when I play, this is why I don't play craps anymore. So I play craps, and I have a good system playing craps. It's all about money management. It's the same concept we do here. I just try to win more than I lose, and I figure and hopefully get about 50-50. So if I win and lose an even amount of times, but I then manage my money correctly, then I'll take more money off the table when I win than when I lose. That's all. It's a slow, grindy sort of way to play, but I like it. Because I'm not playing to win money in craps. I play to get comped. So my system keeps a lot of money on the table because I'm betting against myself. I don't want to get into it. But anyway, it keeps a lot of money on the table. So I'm also, according to the casino, I have a lot of money in play. But because I have all these bets spread out in different directions, which is too complicated for the casino guys to really, see what's going on. But I bet constantly in different directions. It evens out, so I might make or lose a little bit of money. But from their point of view, I'm a high stakes gambler, and they give me great comp. So I get a free room. So I don't care. I win or lose $1,000, but I don't pay for my room. I don't pay for my shows. It's worth it. But I stopped playing craps because it's a job, because it takes me hours to get the comps that I want. Whereas if I go play poker, They don't comp you for playing poker, but it's much easier to win the money. So I just take the cash and give them the cash at the casino. So I pay for my room now. I used to do it all for the comps. And I learned it's better. It's funny. It's a good lesson, though. When I was younger, I used to play for the comps. And now that I'm older, I realize that was wasting my time. And I just sit down, play poker, win money, and I pay for the room myself. So I learned it's better to just make money, make the damn money. Don't waste your time going for freebies. So similar concept to coupon clipping and things like that. It's like I don't waste time with things just to save tiny amounts of money. I tell my kids that all the time too. I'm like, because they're always like, oh, we should do this. It's on sale here, and we go there. I'm like, I'm not going to drive a half hour to save $5. That makes no sense. It's like I try to explain, like my time is worth way, 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 way more than that. But your time isn't, but you don't want to go there without me. So. But people do that all the time. They don't value their time correctly. It's like it's like mowing the lawn kind of thing. It's like I'm not going to mow the lawn. Okay, it takes 2 hours, 3 hours to mow my lawn. I'm not going to spend 3 hours of my time mowing the lawn. I don't think it's fun. And I can just pay someone to do it. I pay them much less than I make. Therefore, I can sit down and work or not work. It doesn't matter either way to them. It's sensible not to do the chore. And that's learning to value your time is one of the most important things you do early in life if you want to be successful, because you've got to understand whether or not something is worth the effort you make to do something. And you find this out also when you talk to venture capital guys. They could love a company. They could talk to you and love your company and so on and so forth. But if it's not going to make enough money for them, even if they think you're definitely going to make money, but if it's not enough money, it's not worth their time. They're like, I'd love to help you, but you're only going to make $1 million, and I'm only going to get 50% of $1 million, and 50% of $1 million doesn't make me. It's not worth my time. I want to make 50% of $1 billion on a company. And also, you have to learn to value stock positions that way too, which is actually one of the reasons. Again, it goes back to like why are we liquidating our portfolios? Well, it's good to start with a clean slate. It's good to not have to worry about them over the holidays. We can say, okay, we have cash now, we can start fresh. But it's also an issue of time as well. We have a lot of positions in the long-term portfolio, and even though they made $50,000 since last week, it's ridiculous. Okay, they made $50,000 since last week. You don't know that that's going to keep going that way. You could just as easily lose $50,000 next week. And since we're up, God knows how much, some huge amount, we're up 260% since November 2013. So 4 years, basically. In 4 years, we're up 260%, which is, I don't know, what is that, 50, 60%? Yeah, about 65%. 65% a year on the average. But what it is that's what 40% compounded is, which is really our goal. Our goal is to make 40%. In fact, we have a video, which we did in 2013, I think, how to consistently make 20 to 40%. Market. There it is. Whatever it was. Oh, anyway, I'm sorry. That's gonna probably mess you guys up. I don't know the video translates. But the point is, 7 steps to making. I guess we have all kinds of numbers here. In the actual article, it was to making 30 to 40% annual returns. It depends on when. I think I changed it to 20 to 40 when I posted it as a video, 2013. We did these videos all prior to doing the portfolios, and the point of the portfolios was to demonstrate the techniques in the videos. But the point is, that's all we did, is we followed these instructions in this video. It's right here. This is how the long-term portfolio works. And I changed it to 20 to 40% because what happened is the VIX got lower, and when the VIX is low, it's harder for us to make really big money. Okay? Oh, here's another one of our videos, How to Get Rich Slowly. See this one down here? That's us too, How to Get Rich Slowly. And of course, we have another one, which is Be the House, Not the Gamble. I'm sure you guys have seen that. That's not us. That's Tasty Trade. So, it's nothing special here about the strategy. All we did is implement the strategy from these videos and put them in. And our goal was to make that 40%. The conditions of the market, look, it's been 4 years. But look at the market for 4 years. So here's where we started, 2013, December. Okay, here. So the S&P was at 17 something, let's say 1,800. Now it's at 26. That's 800 more. Divided by 18 is what? I don't know. That's hard math. 8 divided by 18, 44%. So the whole market is up 44% since we started these portfolios. But the beauty of our system is we don't need the market to be up 40% to make 40%. We need the market to be flat or up. Flat or up makes us our 40%. Down, we could still make some money until it goes down about 10, 20%. Then we start losing money. It's not, there's nothing magical about it. It's not beans. This isn't magic beans. We do lose money sometimes. Okay, when the market has a severe downturn, we are going to lose money. And in fact, we're going to have a lot of stock put to us in a severe downturn, like we're expecting. We can have a lot of our stocks put to us at uncomfortable prices. Again, another reason we'd like to start from scratch and wait and see if we actually get a correction. If we don't get a correction, like let's say it's here. Let's say this is when we start our portfolio. We have a dip over here, but then up and up and up and up and up, and no dip until next year. And then everybody was caught by surprise here. We weren't. We made a fortune. It's funny because our short-term portfolio is up more. The long-term portfolio is up 260%. But the short-term portfolio, short-term, here we go, is up 300%. And the short-term portfolio is supposed to not do well when the long-term portfolio does well. But what happened with the short-term portfolio, and you guys have seen it happen several times, is when we do, we're short on stuff, and we add more shorts, and then finally get a dip like this. Now, when it's a big spiky dip like this one, see how far it went down and then came back up? These are weeks, so it didn't happen like in 2 seconds. These are weekly shorts. These are weeks. So we have a dip like this, and it comes right back up. We cashed. We cash out on these spikes. And so we cash in our shorts, then we let the longs run. Now, so when you make, this is the thing, when the longs lose a little bit of money, but the shorts make up for it in cash, and we cash them out. Our intention is to transfer the money to the long-term portfolio and then use that money to reposition our longs, to roll them down to better strikes and so on and so forth. But because we had such quick recoveries here and here and here and here and here and here, we almost never didn't get a quick recovery. There were no prolonged sell-offs except for this really. And even when this was happening, we were kind of enthusiastically buying. In fact, I have a buy listing this time that we did very well. So we had such quick recoveries that with the cash shift, and we didn't need it in the long-term portfolio because the positions bounced right back. So the money that we cashed in, what we thought was the bottom of the short-term portfolio, we were right about the bottom, but we never transferred it back to the LTP. So the money just stayed in the short-term portfolio. And that became ridiculously profitable. Now, what happened lately, though, at one point the short-term portfolio was up more than 400%. It's lost 100% of the 400%. Because what happened is since last year in this ridiculous run, we've been continuing to hedge with the short-term portfolio, but we've kept our foot, like really on the gas on the short-term portfolio. Like every time the market goes up a bit and our long-term portfolio has a bunch of gains, we keep locking in those gains by moving our hedges up. So rather than using it as a straight hedge like we did here in the earlier times, as the market went crazy, we just kept it as like a real big emergency parachute that we would keep with us. And it cost us $100,000 of gains. But when you're gaining $50,000 a week, who cares? You know, it cost us 2 weeks out of a year's worth of gains. It's ridiculous. But the point is, having the short-term portfolio there allows us to leave the long-term positions on and not worry about it. Now, at this point, though, these long-term, again, we've had several weeks in a row where we've gained like $50,000, $60,000 or $30,000, $40,000, whatever the numbers are. We have ridiculous gains in the last month or so. And it's so ridiculous that we have to either choose to spend $50,000 hedging them or just take them off the table. Just take them off the table. Go back to cash. Give it a month. Breathe in. Take a vacation. I'm going to Vegas. I decided to head to Vegas between Christmas and New Year's. That's why I'm gambling on the brain. I'm like, great, let's get to cash, not have any worries, don't have to look at the portfolio, take a break, go see the family, go meet with friends, have fun, come back in January, start buying things again. Whether the market's up, down, or sideways, I don't care. There's plenty of stuff to buy. We have a buy list. We have lots of things we want to get into. We have things that we're dumping that we wish we have a lot of stocks we're dumping that we wish we weren't dumping in the long-term portfolio. Let's see. Long-term portfolio. Here we go. Here it is. All right. Oh, no, we lost 0.4%. So technically, they're all gone already anyway, so we're cashing out, so it doesn't matter what it says. Look, Ford still wanted at 12. Gannett still want them. General Electric absolutely still want them. GNC still want them. Hovnanian, no, not getting back into the buildings with the weird taxes and everything else going on. Apple, yes. Taser, yes. Barrick Gold, absolutely. Alaskan Airlines, I think yes. Amgen, no. And especially no, because it's a $175 stock, and we're going to have less money. So it's going to change our choices. See, when we drop this thing back to $500,000, it's like $1.8 million now. When we drop back to $500,000, we're going to have less buying power, and that means we're going to be a little bit pickier about, expensive stocks. Blackstone, well, is that Blackstone? I think it is. They're always good. But I think they're high in the range now. Chicago Bridge, we still like those guys. Oh, wow, look how good they're doing now, too. Okay. Celgene, probably not. Chesapeake, probably not. Too risky. Again, we're going to have less money, so we're not going to be so inclined to take big risks. We're going to be looking for the more safer place to start with. We get a little freer and riskier as we make money. But when we start a portfolio, you'll see I'm going to be a lot more conservative than I've been lately, because here lately I've got $1.3 million in cash sitting on the sidelines. Of course, I'm going to, so we take chances on things. We're so far ahead, it's not going to, there's nothing we can do to give us bad performance, right? Cleveland Cliffs, still like them. We just talked about them today in chat. Colony North Star pays a good dividend, maybe. Canadian Bank, too high, nope. Chipotle, that's a tricky one. This spread can make a lot of money. I'll think about that. But it's expensive, so we have to consider that too with margin. Cisco, I love Cisco long term. DBA, always a good hedge, but not working this year. Dying. Okay, anyway, blah, blah, blah. So there's tons of stocks here I'm very happy to get back into, but I don't want to just replicate the long-term portfolio. I want to make these are going to go on a watch list, and we're going to watch them. We have a watch list. It's really easy to find. and kept it under the portfolio tab. Watch list, here you go. So we've got a watch list. And how do you know if you want something on the watch list? Well, I love these charts. That's why I use these. They update. So right now, today, even though I did the watch list a few weeks ago, when was it? November 11th. Okay, so like almost a month ago. So from a month ago, these are the stocks we like. I like GE. It's still cheap. It's very easy to see. It's good. It's so easy to go to the watch list and say, oh, is that still playable? This one got more expensive. This one is still cheap. Who's that? Oh, Energy Transfer. And it's a dividend stock. Ford still in the same range. GCI, note, went higher. Gilead a bit higher, but still playable. H&R Block blasted off. Limited brand blasted off. Macy's blasted off. Wow, what a good watch list. And Hawaiian blasted off. PSA, even PSA is okay. They're still playable. SKT, I really like these guys. That's a good sleeper. Target blasted off. Boy, wow, look at that. We picked this back here. In progress. Okay, I forgot to get back to it. But now it's going to get much, much bigger because we're going to start putting on the people we're taking off in the long-term portfolio. They're not going to disappear. We're going to be putting them onto the watch list, and when they get cheap, we'll buy them. You don't have to buy. There's no pressure to buy something. You buy it when it's cheap. How do you know when it's cheap? Look at the channel. Where do they trade? What's the actual value of the company? Well, that's what this is. What do I think it's really worth? And then look at the channel. And if it gets cheaper, and I write these because this is what I say. If I was trading it now, this is what I would do. That's what I'm saying in these things. If it's blue, I'm saying I will trade it now. If it's not blue, I'm saying if I were trading it now, this is what I look like. Then what you do is when it does get cheaper, not that many of these are, but let's say ETE. So when it does actually get cheaper, because I guess it was 17 or something when I was looking at it, so now you look at the trade and say, oh, here you go, 17.47. So now it's down a buck from where it was. But I said, in fact, I was worried about that. It had to, all that shale has to be transported. ET is the leader in space. It has to have some right springs power. So rather than buy the stock for 17.47 and hedge to collect the 118 dividend, I'd rather just sell the $15 puts way down here for $260. Because why are you buying ET? I'm buying ET because they pay a $1.18 dividend. So basically, I'm expecting to collect $220 in 2 years, and otherwise, I'm basically just going to hedge the stock to make sure I don't lose too much money. But my goal is really to make $220. I'm like, well, why do that when I can just sell the put for $260 right now? I don't have to wait for dividends. I get $260 in my pocket right now, and all I'm doing is promising to buy it for $15. No, don't have to hedge or anything. Now, if we go to ETE and we look at the 15 puts, they're going to be a better price than they were when I said it before, ETE. And now we look at the $15 puts. They're, wow, $330. Okay, so somebody got $330 for them. I don't know if that's still, the spread is really wide. Somebody got $330. So that's much better than we did here. We won $260, 70 cents better, which means it's technically a 30% loss. But we didn't take this trade. We only said we liked it. So now it's 30% better than when we liked it. And if we still think 15 is going to hold, and I would watch the 16 line, but it looks like it's probably going to hold it down pretty sharply off that. Then that means that now you can collect $330. You can collect 3 years basically worth of dividends in one shot for promising to buy the stock for 10% less than it's trading right now. That would go from that's how you use the watch list. Then this would then go from the watch list to the new long-term portfolio, and we sell, let's say, 10 of them, and we collect $3,000. What was it? $330. We collect $3,300 for selling 10 of them. And our worst case scenario is we own 1,000 shares at 15, so we have $15,000. That then would become one of our allocations in the watch list in the energy sector. And that's how we're going to start rebuilding our portfolio when we have a new one. So we're going to talk a lot more about portfolio management and stuff like that. But that's how the watch list works. We have all these positions, and what we do is every once in a while, when we can't think of something better to trade, if there's no news that makes me want to trade something in particular, I just look at the good old watch list and say, well, who's down? Who's on sale that I want to buy? And when this watch list has 40 things on it, which it's going to have, it's 24 now. No, this can't be 24. I guess our old watch list had 24. But when the watch list has 40 things on it from the long-term portfolio that we, again, we're dumping things that we still like. We're just dumping them to clean everything up. So when you have, 40 different things on a watch list, I guarantee you any given week you look at them, you'll find one of them is down enough that you can buy it. And that's all we need to do. So it's not hard to get back in. And not only get back in, but we're going to get back into the same positions we like now, cheaper. Everything we're selling now, we're going to get back into them one by one at lower prices. How is that a bad idea? People are too scared. I understand there's a lot of merits to buying and holding because it's first of all, it's a lot more work to do it this way. And if you're a stock trader, up and down 20% is not going to be a big deal in the market. But if you're an options trader, you can take a 40% hit when it goes down 20% in the market. So it is a big deal. And it's hard to recover from if you don't play it perfectly. So why take the risk? After being burned in 2009, I can't believe anybody who was in the market in 2008 doesn't understand what I'm saying. If you weren't in the market in 2008, you got to look at the freaking chart from 2008. Oh, where is it? Here it is. This is the S&P, right? Whoops. Well, okay, now we got to zoom on it. I'm sorry, wait a second. 2 year, 2 years. And go like that. Now, how does this thing work? This? No. I don't know how to make it go there. Minus? No. Oh, well. Oh, that seems to be working. Okay, look. All right, so here. So, that looks familiar? There you go. All right? Everything was awesome. We went up from about 1,100 to 1,550, 40%. Oh, imagine that. A market went up 40%. Went up 40%. And everybody was predicting these incredible numbers and how far up we go and blah, 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 blah. And here we are on July of 2007. And all of a sudden, this is still July of 2007. This is July 9th. This is July 30th. That's a fun month, right? It goes down, you get caught in it, and you say, oh, well, it'll recover. It does. You can't, it's hard to tell. There's a little red spike here. It bounces, and you go, oh, see? And you're like, I wish I had bought this dip. And then all of a sudden, boom. And nobody who's in the market when this happens is hedged enough. That's it. There's no hedges covering this. That is a massive, massive sudden drop. Extremely unusual. More like 10% in a week. And look at the spike to the bottom here. Okay? And then it seems to recover. And again, now then it gets much worse. And all of a sudden, all the gains from the past few years are gone in less than a year, in 6 months. Sorry. That line I can't turn off for some reason. Anyhow, you never know when this is going to happen. You certainly never know. You don't think this is ever going to happen. Look at this. September, we're at almost 13,000, and here we're at 900. 1 month later. In 1 month, 400 points out of 13,000 in a month, 20-something% in a month. That's after all this relentless selling when you think it's got to be over by now. That's what a market correction is. I mean, that's what I worry about. Because we have just as much of an air bull market here as we did here today. We've gone up and up and up relentlessly without a proper correction, and there's no way you can justify this kind of growth in a year. Okay? What you're saying, if you think this is real, then you're saying that everybody, all these people, look at this volume, all these people who bought stock all this time were idiots because it was worth double what they were paying, 50% more than they were paying. And all of these suckers who sold had no idea how to value a company correctly. Not one of them, not the hedge funds, not the quants, not the computers, not the individual investors, not Warren Buffett. Everybody who sold a stock ever was an idiot. And only now do we know and understand how valuable stocks really are. That's bullshit. Okay? That's bullshit. Millions of people trading trillions of dollars worth of stocks. That's what a 200-day moving average is about. And when you're too far over these 200-day moving averages, you have to say to yourself, I think maybe this is wrong. Not the crowd is wrong. Not the 200-day moving average is wrong. You have to say to yourself, maybe the stock is wrong. Maybe the market is wrong. That's the 200-day moving average. 2450. 200 points was only 10% below. Still very bullish, but it's 10% below. We haven't had a correction. We haven't tested it since before the election. After Election Day, we've been almost consistently 10% above it since. Okay, when we correct, we're going to correct down all the way back to there at least, and probably overcorrect another 10%. That'll take us down to maybe 2,300. But there's nothing wrong with that. That's called a consolidation. That's how you get price discovery. That firms this number up, and then we say, I'll say, we're way too cheap. Let's start buying things. And not because of the stupid line, but I'm just saying the wisdom of the crowd in valuing things is represented by the average 200 days moving average. It's 200 days of trading, basically a whole year of trading stocks. Trillions of dollars traded back and forth by people who are paid for a living to analyze the value of the stocks have determined the correct price to be here. That's what the correct price technically is. Right now, you could argue that it's backward-looking, that it reflects the past, but that's not true because people are trading stocks with a forward-looking bent. Obviously, they're trading now with the expectation of tax breaks and so on and so forth. So people are looking forward. It's already included in the line. As of today, the sum total of that line is way, way below where the line is. We're overbought by any rational indicator. This is an overbought market. So rather than spend another $50,000 or more fixing our hedges and adjusting hedges and pushing everything up higher, just to make another $50,000 or $60,000 or $100,000 next month. I'm like, why don't we just chuck it? Let's cash out. That way we lock in all these gains. They're cash. We put them away. And now next year, we're only going to take $500,000 out of our $1.8 million long-term portfolio to re-gamble. So the $1.3 million, that's boom, safe. And if you guys want to talk about it, we can always talk about things to do with $1.8 million on the side. But, that's safe. And by safe, I mean I'll put it in a hedge fund, so somebody else can manage it, just, carefully manage it and keep it consistent. Or I'll put it in some interest-bearing things. I'll buy some muni bonds. Hopefully I'll figure out some municipalities aren't going to go bankrupt, most likely. Not in New Jersey. But maybe like Florida or something like that. Find some states where people aren't going to be like dumping out of. And you can buy commodities and whatever. We have 2 Bitcoin. PSW Investments has 2 Bitcoins. They're making us a fortune. So 2 Bitcoins we bought 2 years ago for $600 each, and now they're $12,000. So what's that? 20 times our money in 2 years. I mean, they're just giving money away. And if they're going to give money away, we're going to participate. But also, let's take some off the table and lock it in. And I think I told you guys that last month I cashed in my kids' college account. When we hit here, I cashed out my kids' college fund. They're not cash, but I put them into whatever their money market is or whatever. But their money's still there in the college fund. It's just in cash. And I haven't yet had any reason to get back in. I'm probably not until January. And now, since we then went from here to here, I said, you know what, let's cash in the portfolios too. Same logic I have with my kids, though. I wasn't willing to take a chance. Now, my kids' college fund, I made one phone call, boom, it's done. I was hesitant to do that with our own portfolios, although I told people that's what I was doing here. But then now that we got all this bonus money, another $100,000 plus fell into the portfolios, I'm like, screw that, let's take it and run. So maybe it's a good decision, maybe it's a bad decision. We're not going to know until we see if we survive. Last year, in December, what would not have been technically a good decision. It's just basically a hassle that we got out of all the stocks, right? This year, in 2015, we'd be like, well, thank freaking God we dumped out before this happened. That's a 20% correction. Oh, no, it's not even, it's only a 10% correction. That's what a 10% correction looks like. Or 15 maybe, I guess, it's at the very bottom. That's a 15% total correction, basically. Look how fast that happened on January 1st. That's what I'm worried about now. That's what I think is going to happen in January. So I think, see this low volume here? See this low volume here? Did not, I mean, here, well, this is Christmas, but this huge gap, and you have this kind of volume lower and the market rising higher. This didn't really have that. So this didn't have the rising market, but this one had a rising market on low volume. We have a rising market on low volume. And that's the kind of thing that happens towards the end of a rally. Because what happens is everybody stops selling to see how high it's going to go. And the money still, people come in still chasing it, but meanwhile, there's no actual buyers down here for it. It's just an absence of sellers taking the market higher. And that, by the way, that's another huge reason I want to cash out now. If you wait till here, there's no buyers. That's why it goes down so fast. If you wait until everybody decides to sell, you won't find anybody to buy. And you'll be selling at panic prices. Right now, there's tons of people buying our stock. We have no problem dumping our position. Everybody wants to buy stuff right now. So it's easy to sell, it's easy to liquidate, it's easy to get back to cash. Well, if I told you here to get out, even if I'm right and I call it right, how many of you would actually get out before this happens? It doesn't make any sense. So I've got to be ahead of the call to do this. I've got to err on the side of caution. All right, so I apologize if we're all wasting our time and it turns out like this. But if it turns out like this, we'll be buying in January if it doesn't look bad. If we get to the start of earnings and earnings look okay, we're going to be buying and we'll catch the wave up. But I don't see any January where I say, oh my God, I missed it. There's no period here. There's nothing, obviously here you didn't miss anything if you weren't in. If we go back a year, well, I don't know if you can go back a year. No, you can't. But anyway, you never know year to year. But I'm just saying, I don't like this. I don't like how high we are. I don't like where it's going, and I'm very concerned. So I want to be out. I feel better about it. All right. Anyone else saying anything? No. Why are you all so quiet? When are you heading to Vegas? I will be there on, I guess the 26th, something like that. And I'll probably stay until New Year's. So that's my plan. So that week I'll be live from Las Vegas. So no one's talking about anything? I'm wide open for topics right now because we don't have any positions. Let's see what's going on in the portfolio. The indexes. Let's see. How's gasoline? Drifting along, so that's fine. Natural gas is moving up a little bit. That's fine. Silver. Oh, silver's making a little bit of a recovery. Very nice. Yeah, I like silver a lot. SI is silver down here. And we're in for, was it right where we're in 1604, so we're in over here actually. So this is still below where we are. Anything above 16, especially right now at 16, you can play it with a tight stop at the 16 line, so you can't lose much. And again, it's all these things you're about. If I'm bullish on silver at 16, then I play it here. I put a stop over here. And it's either going to go up or down. But since I'm only going to lose a little bit on the way down, but I'm not limiting my move up, then my win-loss ratio is very high. I've got a much better reward to risk. So it's a sensible play because I have a good stopping line, 16. It will tell me I made a mistake and it wasn't the right time. What's this? So that's natural gas. The RB is down currently. It's down a little bit from when we came in, but it's only 1, so we'll see what happens. But that's how you do it. And I see I have 73 buyers and 16 sellers, so that means that there is pressure to the upside. 68.19. Oh, 68.70. It's looking good. It's looking like it's going to pop up. Oh, and there it goes. See that? That's how you watch these things. Oh, but these guys now, what I learned there is that these guys are very determined sellers. They're probably not willing to show their hand, but they are anxious to sell when you get up to them. And there's 61 of them. And there's not, by the way, this is just a block that's being offered. So it doesn't mean there's only this many. But now there's 56, 57. So they're getting, you want to see if they're getting chewed up. So there's 11 here. These are very steady. It's a steady buyer coming in, 17. So this buyer is really eating all this stuff. He's taking out all these guys. That's a pretty good buyer. And again, it's not one guy. I just like to anthropomorphize. Is that the word? Anyway, I like to personify. And maybe that's the word. Maybe the other word is wrong. I think the other one's about like cartoon animals or something. Anyway, I like to personify like the person. I like to think of them as like a person, each one. So, I look at the position like, well, what's this guy doing? What's that guy doing? There's obviously not one guy. But I look at it as like there's a guy who's buying and there's a guy who's selling. And so to me, this guy who's buying is being careful not to show his hand, but he's pretty relentlessly buying whatever these guys are selling. And by the way, they're not showing their hand either. They just keep feeding it. Every time he buys, they sell more, but they keep it at 55. Okay, there's a program doing that. There's a program that's on purpose. They don't want to scare away buyers by showing, showing a sell order for 100 contracts or 500 contracts or whatever they really have. So they keep feeding it up to a certain level. The computer is told, keep selling, but don't sell if this number of contracts gets higher than 56 or 60 or whatever the number is. So they're going to keep putting contracts in every time it gets a little bit below 50, below 60. but they're not going to keep, but you won't know how many they're really trying to sell until it's all gone. But what you will know is that when 50 starts failing, since clearly they're keeping it above 50, when 50 starts failing, then this is going to make a bullish move up. And also you want to watch this and see how this guy holds up. It went from 18 to 9, now it's back to 19. And see how they keep steady? You got 17. So these guys are getting their fill. They're selling. They're buying. But these guys aren't budging. So there's FC 14, but he's still high. He's still at 59. That's exactly what I said is going on. He's at 10. He's still at 58. So how come he's buying, but they're not selling? That doesn't make any sense, right? But what's happening is as soon as he buys, they fill it back up again. And you're talking microseconds, so you can't even see it happening. Here's 21. Here's 56. Here's 16. 5 just got filled immediately. 57. No movement here. All movement here. Up, and it dropped. So you finally filled this guy out, and now it dropped down. It doesn't mean these guys are gone. It just means this is new. There's 22 people drop down to this level. 30 people drop down to this level. So now there's probably a new round of sellers. But they ran into a bunch of buyers here. 70 buyers over here. So as long as you see more buyers than sellers, you can be pretty confident that it's not going to go down much. You're now at 84 and 10. So this is, so that 16 line is looking pretty good for a long position. And again, you watch these things. It's like watching paint dry, really, because it's not exciting. It's not doing anything, and there's no particular catalyst right this second that says it should be going up. But basically, we're expecting, just like I said, we're just watching to say that 16. If we hit 16 again, well, that's the problem. Now, if we hit 16, it means that the buyers are weakening. So I might not want to jump right back in if it hits 16. But I am feeling good about being long at this spot. Meanwhile, RB is pulling back a little bit, but nothing significant. Natural gas is still drifting higher, and they're going to stop trading soon. It's 2:30. They stopped trading around 2:30, I think. I want to at least stay out of profit. So that's how you keep an eye on these things. Now, you can only do that with a heavily traded thing like silver is heavily traded by comparison. Natural gas is very thin. RB is pretty thinly traded with 2-in-1 contracts. You can hardly tell anything from that. Oil, though, on the other hand, is very heavily traded. So you can actually watch oil, and oil gives you a clue about what gasoline is going to do. So here you got 55, 57, very evenly matched at this spot. And they had a little run to pull back, which is bad for gasoline. Oh, and there it goes, right? If even oil pulls back, gasoline's going to pull back too. That gives you a clue. And then of course, you should watch the dollar. When you're watching natural gas, you watch the dollar to see what the dollar is doing. Because if the dollar's strong, that's going to put pressure on oil and natural gas. You see how the dollar went from here to here, and oil went from here to here. So you have the inventory report, but you also have the strong dollar giving oil a bad day. So you always have to think about what factors are affecting the trade that I'm in. It's not always just one thing. So let's see. This number is 167. So I don't want to add another one. I want at least 166 before I add another one. So I'm not even interested. It has to go below this green line for me to want to add more. Now, oil, if it makes a W here, if it forms the bottom of this leg and retests 56, that'll be a good time to buy the next piece of gasoline. So even though I want to be at 166, I'm looking here and saying, well, last time we only got to 166.24, and that's what matched up with the bottom of oil. So if oil retakes this bottom but holds it, I better buy my gasoline right there, whatever the price is, because that's as low as we're going to get. Oil will probably bottom and bounce before gasoline bottoms and bounces. and it's a little tedious to trade the futures. And again, most of my trades are longer-term conviction trades. I don't really do a lot of day trading the futures just because, again, it's not a good use of my time. But honestly, though, you can make a fortune because, it doesn't look like it now. I'm down $600 over here. But realistically, when you get good, if you get consistent and make the money that you try to make, if I can make a couple of $1,000s a day trading the futures, and I can trade 200 days a year, that's $400,000 a year just trading these stupid things. That's good money, but it takes many, many, many years of practice to get good enough to consistently make money at the thing. And you're not going to make money every time. You have to learn more so than just making the positions is learning to manage your money effectively. That's the key to the whole thing. You have to really, like I'm telling you some stuff that I'm watching and why I'm in it. So I've only got one contract. That's why I started with one contract. I don't know which way it's going to go. The silver, I'm not worried. I got perfect conviction on silver, so I'll sit down. I'll take a loss. I'll take a pretty massive loss on that one. I could care less because I know eventually it's going to go back up here, and it's a very big amount of money. Getting close to 16. I still want to do that. Since it's creeping down to 16, I would like to test 16. Let's put in a buying season still. It's not gonna. Not until these guys are gone anyway. But see, I'm worried here because we're hitting this line. If it bounces off this line, I'm never going to get a chance to double down. But I got to see oil stop and see what oil, I want to see oil start recovering. A lot of buyers here, 112.43. But again, that's not the be all and end all because you don't know if this is getting fed into. 76.22, 85, 137, 45.81. Seems like there's a lot of guys here. 45.95, 28.96, up 59. See, they keep. That seems like a hidden buyer is pushing in here. Yep, there he goes. All right, well, that means it would be time to add another one here. You can get a fill. Oh, wow. That was way too easy. It makes me nervous when I get an easy fill like that. But the signs are looking like oil is going to at least hold this W piece down here and make another attempt to go up, and so gasoline will go up. And now I only need to get to 1667, which is 667 right there. And then I will be even. Seems like a long way, but gasoline's got very, very tiny tips, like hundreds of percent. So it covers ground. Sometimes it covers ground so fast you can't even figure out where it went. Like things like flipped off the screen. And what the hell happened? If it goes up a penny, that's like you have to search for it on the wheel here. Like, look, here's 1664. Where's 1674? We're not even in the 167s yet. Page. Oh, here's 167s. Still going. There it is. So 1674. That's a long, long way away. So a penny move in gasoline is a massive, massive move. So now I have two, though I wanted to really badly, as you can tell. So now I'm happy. And you see how we're getting the green on oil here? Suddenly it's turning green a little bit. So we'll see what happens. But my theory is that we're going to hold this the way it was trading. I got a feeling we're going to hold this. And then when oil starts going up, gasoline starts going up too. So it doesn't have a mind of its own, really. So unless something really weird happens, gasoline is just going to follow oil wherever it goes. And now I'm hoping that we get back to at least this part of the W. And that's going to give me a move back to probably 167. And that's past where I'm going to be even. And then if we fail at 167, I can take a little bit of a profit off the table and be left with one long at a very cheap strike. Look, we're already almost at my break-even goal now. That's my break-even spot. So see, we were down $200. Now we're down $40. And again, I'm not happy playing one contract or two contracts. It's not enough money to make me even interested in watching it. But if your goal is to make a couple of $100 a day, which again, a couple of $100 a day is $40,000 a year, then the real move would be to take right now, in fact, what? In fact, let me do that just to show you. If I put a sell in here, so just click the sell. If I sell, what's going to happen is I'm going to go back to one contract even at a much lower strike than I started. If I hit it. If I don't hit it, it doesn't go. But it doesn't have to be there. I could do it. Oh, shit. So it doesn't have to be there. It could be anywhere. I could have taken that money when I was only down, now I'm down 200 again. Isn't that funny? It just went the wrong way because the oil fell. Shit. I had a chance to get half out even, and I didn't take it. But that's the thing. You don't have to wait until you're exactly even. At any point I took this, I would have made back a lot of the money I had lost. Now I'm down, instead of being down 200 at the same spot we were before, I'm down 350. So I have two contracts now instead of one. But as I was saying, even two contracts is not going to be enough to make me happy, even if it gets to my goal up here. So still at now I'm 1667, and I want it to be at 1665. So 166. So I have to think to myself, how do I get to 1665? I need two contracts that are 2 cents below that number, or one contract that's 4 cents below. So 162 is going to take me down to, I think that's right. So I don't want to do it right now. I want to watch oil because oil's going to set 56. But right about here, oh, come on, don't bounce away from me. If I added one more contract here, I think I would have hit my 165 goal. I was hoping oil would come down a bit more, but it's not. Oh. See, making my money back, I'm so annoyed. Because I would have rather had the fourth contract. Sorry, the third contract. Come on, baby. Is my math right? If I have 162, and that's 7, no, that's not enough. Let's call that 7. I have 2 at 7. My goal is 5. I need to be 4 cents under. Not 4 cents under this. I need to be 4 cents under 5. 161. So right about here. That's where I need to buy. I think that'll do it. But again, things don't have to be exact. You just have to, because it's going to accomplish it. Even if I come in a little bit higher, it's still going to accomplish my goal. But here we go. All right, let's take it. There we go. Oh, 1651. Damn it. So close. So there I am. Now I'm at 1651, and now I'm immediately going to, now I definitely know I want to sell. When I get back to 165, I will definitely take this money. But since 165 is over the 165 line, I'd rather be below. So I'm going to sell here. And I'll put it in order right now to sell it. Well, what happened? Well, there, the thing jumped. So now I'm just going to put it in order to sell. That'll bring me back to 2 at my goal at 165. 1665, sorry. But you see what I'm doing? I'm lowering my basis. By adding the contracts, I lower my basis. Then when I get back to the lower basis point, I then reduce the number of contracts. And then when it pops back up again, if it goes down again, I might lower my basis again. So I'm just keying off that. Now I have 3 at 1665. I won't add more unless I can start lowering my basis to 160 to take out that point, at least that 5. So it has to be at 1555 before I'm even thinking about adding another one. I'm sorry, 1655. Ugh, so confusing, so many numbers. 1655. But if it goes that low, I think I'd be kind of worried about the whole thing collapsing. So we will see, but I'm pretty sure 56 is going to be bouncy on oil at least. Although we were wrong about the bottom W holding, so we'll see. Now I have 3 contracts that have the pleasure of being down $500. All right, 56. This is a big test right here. We bounce at 56 or don't we? Now, if oil fails 56, I should probably get out. I'll take my $500 loss and try again some other time. Because if oil can't hold 56, and gasoline probably isn't going to hold 166. Ooh, look at it go. Scary. But of course, also the NYMEX is closing in 5 minutes, so people are dumping out. Oh, there we are, 55.98. And by the way, when I say holding, I don't mean the 2 seconds it spikes below. I mean as a general thing, holding. But it does look like it's not in good shape here. I want to see a much faster snapback than that if I'm going to be confident. I'm certainly not confident watching this thing. 55.95, that's bad. But, wait, 55.97. All hope not yet lost. 96, 95. Season futures trading fun. It's actually more fun playing craps. And you're just as likely to win. So like I said, it's not about winning and losing. It's about managing your money. It's about the fact that if I'm right, I make a couple of $1,000, and if I lose $500 or less than $1,000. And all I have to do is be right half the time. If I'm going to win $2,000 versus losing $1,000, all I have to do is be right half the time, and I'll do very well. Right? Because think about it. If it's let's say you take 10 chances and you lose 5 and it's $5,000, but you win 5 and it's $10,000, you're going to net gain $5,000 in 10 chances. Make sure that your reward is higher than your risk. You have to have a plan going in and a plan going out every single time. That's how you win. All right, so I think at this point I'm getting a little more confident. Looks like it's going to hold. I'll be a lot more confident if we get back over 56. By the way, if you want to play oil long, over the 56 line is now a great place to play it, if we get back over it. But if we get back over it, you can play it at the 56 line, and if it goes a penny below, get out, and $10. Here's an example. If you pick up oil at 56, if you pick up oil at 56 and it goes even a tiny bit below and you get out, these are like $10 per box to lose, right? So you lose $10, $20, whatever. But you're not limiting your gain. So if you pick it up going over the 56 line and put a stop at the 56 line, what's going to happen? You've got a better chance of making money than you do of losing it. Not better. You have a chance of making more money. You have an even chance of winning or losing. If you go up or down, you have no possible way to be sure either way. But if it does go up, and you're not going to stop out on the way up, then you could get lucky and catch a really nice run that makes you $1,000. If you're unlucky, you're going to take a $10, $20, $30 loss. That's where you get a positive risk reward. But what you have to do is you have to watch and observe and wait for the good lines. And the good lines are usually in oil the 50 or the 25 line. Those are the good lines on oil. And on gasoline, it's a penny and a penny and a half. On silver, it's basically generally moving like, it's kind of an odd thing. It kind of does 15s. It's weird. I guess it's not that weird. It's like 15 cents. The 15 cents is one 1/100th of the price. So I guess it moves in, increments that make sense to the computer. Oh, here we go. Watch. All right, let's go. We're going to buy one. I'm going to show you what I mean. So I bought one. I'm assuming it's going to break over 56. If it doesn't, I'm going to get out right about here. and take my little loss. So my risk is losing $20, which here it is, $10 down now.